Financing new ventures and the debt ratio. Hello and welcome to the new leadership team of Likert Incorporate. I hope that you are all ready to embark on this adventure of saving our company. As you are already aware, we have received a letter from our supervisory board. Unfortunately, Likert is currently in a very disadvantageous position. In order to gain back market share and success, we may use external financing sources to grow the business units and gain a competitive advantage. We therefore would like to give you an overview of how to finance new ventures in order to help you make the best and most valuable decision for the company. But before we examine the financing options, let's see how Likert has been financing its operations until now. To do so, it is helpful to look at the debt-to-equity ratio. This ratio is mostly used by banks and investors to determine whether a company is operating efficiently and sustainably. It depicts the amount of debt and equity a company uses to finance its business. It is calculated by dividing a company's liabilities with total equity. Calculating Likert's debt-to-equity ratio leaves us with a low value of 0.0539. But what does this number indicate? A high debt ratio signalizes that a company is highly leveraged as it uses debt to finance its growth. This indicates a high-risk investment because the business might not have sufficient cash to repay outstanding debts in the event of a business downturn. On the other hand, a low ratio indicates that a company hasn't relied on borrowing to finance its operations and possibly hasn't realized the maximum potential of external funding to generate profit and growth. With a value of 0.0539, this is the case for Likert. In order to change this and find a balance to grow and save the business, let us examine what sources of funding are actually available to us. Generally speaking, a company has three options of raising external capital: debt financing through bank loans, equity financing through venture capital, and the intersection of both, venture debt lending. Let's start off with the most traditional option: debt financing through bank loans, also called bank financing. In debt financing, we can generate working capital by taking on debt in the form of a loan from a bank institution. To mediate risk, a loan is generally secured with an interest rate and a collateral, which is an asset pledged to the company by the bank for the life of the loan. If we default, the collateral is seized by the bank. So to receive a bank loan, a company needs enough collateral and cash flow as security and a low-risk business opportunity for the bank to secure a full repayment in the future. This is why mostly larger and more mature corporations access bank finance. By doing so, they keep full control and ownership of their business, as bank finance is of purely financial means. Think of securing a loan to buy the car of your dreams. It will completely belong to you, and the bank will not tell you what color to paint your car. But if you don't repay the loan, it can still take it away from you. But let us look at a clearer example from the business world. In 2016, Bayer took over Monsanto. To finance the takeover, the group required a bank loan. As Bayer is a well-established and highly experienced business in its industry, it was eligible for the high amount of debt it needed. 6 of the biggest banks in the world provided a record-breaking loan of $67 billion to fund the takeover, in exchange for a 0.5% interest rate each, growing over time. But as everything else in life, bank finance has its advantages and disadvantages. Let's look at the bright side first. With bank finance, you can raise a lot of capital while keeping 100% of your company's ownership and control. Moreover, the interest rate payable can be deducted from a company's tax payment, and once debt is fully repaid, there is no further liability to the debtor. But there is a downside. Bank finance requires repayment, and the increased debt could be a strong burden, especially for startups. Banks are usually not a good fit for young ventures with low collateral resources and high risk of failure. These companies will usually not be able to receive bank finance due to their risk of inability to repay the debt. These high-risk, low-experience, and low-resource ventures can benefit from another funding option: equity financing through venture capital. In this case, investors, called venture capitalists, provide financial aid in exchange for equity. This is usually offered in the form of shares, representing a portion of ownership, including partial control and decision-making power. However, venture capitalists not only provide financial means, but also managerial input to the business. The VC's motivation to offer venture capital to emerging businesses, even those with a high-risk nature, is the outlook for significant returns when the company becomes a success. Thinking back of our car. If a VC helped you finance the car, you unfortunately have to give up a certain amount of ownership. This means that they can repaint the color of your door or place an annoying fragrance tree on your windshield. But jokes aside, let's have a look at a real-life example, the mobile bank N26. After its foundation in 2013, Axel Springer Plug and Play was amongst the first VCs to invest in the high-risk company. In exchange for $25,000 of capital, the VC received 5% of N26's shares. In addition, their investor provided N26 with access to strategic partnerships, office space, and a network of other renowned investors. To summarize venture capital, let's look at the pros and cons. Especially young companies can benefit from equity finance, even though they might lack experience or financial resources. And compared to bank finance, they do not have repayment pressure. Far more important than money, though, is that venture capitalists want your business to succeed. Due to their expertise and network, they can have a positive influence on the company's growth. The advantage of this shared interest between the two parties comes with a downside. In exchange for financial and managerial support, the company has to give up a share of ownership and therefore also profit, control, and decision-making. While venture capital itself supports companies for longer time periods, there can be times when additional working capital is needed for startups in the short term to achieve their next milestone. Think about the red/yellow Porsche that you paid with the investment made by VCs. For the winter, you are in need of expensive winter tires that will get you through the season safe and fast. You cannot afford this investment alone, so the special case of venture debt lending comes into play to help you out. Venture debt lending is a form of debt financing that complements venture capital funds by providing loans to venture-backed companies. It therefore lies at the intersection of venture capital and traditional debt. The venture debt lenders, the VDLs, provide short-term financial support, mainly to startups with a lack of resources required for bank debt. VDLs issue such debt with a specific interest rate as well as warrants or rights to purchase equity. In some cases, startups offer tangible assets in the form of patents as collateral. So what are the pros and cons of this third option of raising capital? On the bright side, venture debt lending offers startups a source of debt at far better terms than the traditional bank loan. As an add-on after a venture capital round, venture debt can help a business fulfill short-term financing needs without giving up more ownership. However, venture debt lending must still be repaid. If a company fails to realize its projections or must use investors' capital to repay funds, it might put the company in a disadvantageous position. In the worst case, the lender may even force the company into liquidation or bankruptcy. As you can see, the source of external funds highly depends on the nature of your business. In order to raise capital for Likert, you should carefully consider and evaluate these funding options. We hope this video helps you and that you will bring new hope, energy, and diverse experience into Likert. It is now up to you to make a decision. Good luck.